everyone, welcome to tonight's program. I'm Jenna Spatz. I am a former co-chair of the family law section of the Beverly Hills Bar, and we're really looking forward to tonight's program on tax and family law issues. Before I introduce our panelists, I want to go over a few housekeeping items. MCLE materials were emailed to everyone. Also, an MCLE certificate will be emailed to you following the program. Please keep that for your records, and please fill out the survey that's sent to you as well. There's a question and answer feature in the Zoom, so please feel free to send your questions to the participants, and they'll do their best to answer the questions as they come in. I want to thank tonight's sponsors. This is a joint sponsorship between the family law section of the Beverly Hills Bar and the tax section. So we're happy to be working with both sections to put on this event. And I also want to specifically thank the sponsors of White, Zuckerman, Warsavsky, Luna, and Hunt, our family wizard, and Hockman, Selkin, Tasher, and Perez. And without further ado, I want to introduce our panelists. Alexandra Leichter, my partner, but without being biased, an excellent family law attorney and litigator. Jack Zuckerman and Avi Reichman, two of the top forensic accountants in the field of family law. And tonight's program is going to feature and inform everyone about common and new tax issues that family law practitioners need to know and be aware of as they represent their clients. So without further ado, I will turn the presentation over to Alexandra.
Thank you. Thank you, Jenna. And Jenna, as my law partner, put a gun to my head to do this program. We did this program, or very similar one, I think, Jack and Avi last year, right?
Yes.
And it was very popular. So Jenna says, okay, here is where we can fit you in October. So let's get it going. Thank you very much, Jenna. And next time I'll put a gun to your head.
Looking forward to it.
Actually, Jenna is correct. Jack and Avi are two of the top forensic accountants that we use in family law, and I'm sure a lot of you are already familiar with them, but you'll actually hear them and see how, their breadth and length of knowledge is interminable. So we're going to be talking about PPP loans, ERTC credits, other tax traps that family law attorneys need to know, but I'm going to give you a hint ahead of time. Stick around, because in the middle of the presentation, you will get to save money on the SALT, on AB 150, which Avi is going to talk to you about, to save money with respect to the SALT treatment that we're subjected to as California residents. So I suggest you wait, even though tax, I know everybody, when we did all these CFLR programs, we were ready to kill ourselves because it was always on those 3-day programs. The second day or the first day, we start out with taxes. So pay attention. Jack, take it away.
Okay, we're going to go to slide number 2, PPP loans and ERTC credits. I will be speaking about PPP loans, and this particular slide just gives you the actual terminology for the congressional acts that cause these loans to come into existence. And Avi will be talking about the ERTC, which is the third item in the slide. So without further ado, I'm going to turn it over to Avi to start off with the ERTC loan, ERTC, and what it is. Next slide, please.
Thank you, Jack. So the ERTC, also known as the ERC, or Employer Retention Tax Credit, or Employer Retention Credit. It's actually an area that's very near and dear to my heart. I've spoken to a lot of practitioners about both PPP and ERTC. And the second a PPP comes up, almost everybody immediately tells me they applied for it. Either they got it the first round or they got it the second round, or both. When it comes to ERTC, the reaction that I most commonly get is, oh, that doesn't apply to us. And there's a reason for that. When this first came out in March of 2020, businesses had the option of either getting a PPP loan or an employer retention tax credit, but not both. And as you can see in the slide over here, the initial credit was capped at $5,000 for the year of 2020, while the PPP could provide significantly higher dollars. So most people did not choose to utilize the ERTC and simply forgot about it. As a result of the Consolidated Appropriations Act in December of 2021, a couple of changes took place. First one, the one that's most significant, is the maximum credit amount was increased to $7,000 per quarter in 2021. So to put that in perspective, 2020 maximum of $5,000, 2021 maximum of $28,000 per employee. This is a credit that is applied for on your payroll tax return, and it is a refundable credit. And one of the reasons I think so many practitioners are not aware of it is typically most businesses have their income tax practitioner, and they'll outsource payroll to an ADP or a Paychex of the world. This is not something that shows up on your income tax return. It shows up on your payroll tax return, which would typically be filed by your ADP, Paycheck, or other payroll provider. So many people simply aren't aware of it. There are limitations based on whether you're a large employer or not a large employer. The main difference being that if you're a large employer, you can only get the credit for wages paid to employees while they were not working, as opposed to if you're not a large employer, you can get credit for all payroll dollars, except that you can't use the same payroll dollars for the ERTC and the PPP. So who qualifies? Businesses that were ordered by local governments to fully or partially shut down. That's
all of us.
So
actually,
initially, when this first came out, the expectation is that it would apply to all businesses, but the AICPA has subsequently come out with guidance that said if you were able to work from home, for example, that would not be considered a full or partial shutdown, as opposed to if you had a restaurant, for example, that you were mandated to operate takeout only or outdoor dining only, that would be considered a partial shutdown that would make you eligible for this credit. But the one that applies to many law firms, accounting firms, and other small businesses is businesses whose gross receipts fell different criteria in 2020 versus 2021. In 2020, you had to have a drop of 50% versus the same quarter of 2019. So if Q2 2019, your revenues were $1 million, and Q2 of 2020, your revenues were $490,000, that would be a 51% drop, and you would qualify for the credit in 2020. Remember that in 2020, the credit was limited to $5,000 for the year. 2021, you have a much greater credit, and to qualify, all you need is a drop of 20% in any quarter of 2021. So you would measure your 2021 quarter versus the same quarter in 2019. So if you wanted to see if you qualified in the first quarter of 2021, you would look at your Q1 2019 revenues, compare it to Q1 of 2021. So remember, you're comparing 2021 to the comparable quarter in 2019. In my hypothetical example, if your revenues were $1 million in Q1 of 2019 and Q1 of 2021, your revenues had decreased to $799,000, a drop of just over 20%, you would be eligible for the credit, which could be worth as much as $7,000 per employee per quarter. And you can qualify based on gross receipts for that quarter or the previous quarter. Meaning if you have a 20% drop in Q1 of 2021 as compared to Q1 of 2019, you would get the credit in Q1 of 2021 and then you would also get the credit in Q2 of 2021. Next slide.
Okay.
Okay, so Avi, how much money did you save on the ERTC?
How much money did I save? I think it's going to be over $250,000.
Okay, folks, I think
I think you just qualified for this program.
Go see Avi if you want to get some money back.
Business is going great. Remember, it's a timing issue. You compare one quarter to another quarter. Q1, I could have been down 21%. Q2, I could be up 200%. It wouldn't matter. I would get the credit for the first 2 quarters of 2021. Q3, we'd have to run the calculation again. Again, could be down 20%. In Q4, I could be up 200%, would still qualify.
And the comparisons are always with the 2021 year with the 2019 year.
Correct.
So that was 2019 pre-COVID. So I think that they assumed that you're going to have a Great Depression in terms of the income, which is why this whole ERTC was created, right?
Correct. Now, there is some talk that it's supposed to be for all 4 quarters of 2021. There was some talk of it ending as of September 30th and only applying for the first 3 quarters. But as of right now, the ERTC is available for 2020 and all 4 quarters of 2021.
Can you go back retroactive to 2020 and the first 3 quarters of 2021 if you haven't done it until now?
Yeah, so you get the credit on a payroll tax return. If you didn't account for it on your originally filed return, you can go back and amend your payroll tax return. I believe you have 3 years to do so.
Nice. Good. All right. You've just earned your keep, Avi.
Yeah, absolutely.
Just keep in mind, it's a quarterly calculation. People think revenues had to have fallen off a cliff. Not necessarily. Just compare one quarter to another quarter. You may have had, a big settlement come in 2019 in a particular quarter that would cause 2021 to be down relative to 2019. Or you may have had a timing issue in 2021 where a client paid late and it caused your revenues to go down below that threshold.
Okay, Jack, take it away.
Our firm didn't do so well on ERTC, but we did very well on PPP. Okay. And that's what we're going to be talking about now. And the question is, when your clients have received PPP loans, how do you treat them when you go into court and are looking at the support calculation? Are the loans considered as income available for the loan proceeds, I should say, considered income available for support or not? And if they are, when do you consider those loans income available for support? Now, fortunately, I had a recent case in which I testified in person downtown in which this was an issue. And the judge resolved the issue by acknowledging that the PPP loan was income when forgiven. So irrespective of when the PPP loan with proceeds actually came in, the date that forgiveness was the date at which the loan became income available for support. And he did it through an Osler-Smith order, so that whenever it happened, within a few days of the occurrence of the forgiveness, the supported spouse can then either through the formula in the court order, or if you settle the case, whatever the case may be, come back and ask for the additional funds. Now, the typical loan is not included in income available for support because loans are typically not forgiven. And when a loan is forgiven, it is taxable income. So in essence, what the court's criteria is the date of forgiveness, is the date it becomes income available for support, even though it's not income that's taxable, except, of course, in California for those people who have PPP loans in excess of a certain amount. So I believe I covered all of these points in what I just stated a few moments ago, but this slide will be a refresher, a reminder, in essence, of what I just went over. Let's go to the next slide.
Okay, Avi.
Okay, back to the ERTC, Employer Retention Tax Credits. How that factors into income available for support. So we have to remember this is a credit that's available for 2020 and 2021. This is not an ongoing credit. So any ERTC should be considered as a non-recurring one-time event. If it's going to be received in the future, an Osler-Smith treatment would be appropriate. If we're talking a retroactive period, it should be considered income in the retroactive period because it was money received and or treated as a reduction of payroll expense.
Now, I want to add something in here. I think people should be aware of the fact that just because something was available in 2020 or 2021 doesn't necessarily mean it won't be available for 22. And this program is done a bit prematurely because we don't know what the Biden administration is going to do with our tax issues, and they're hammering out as it stands right now. So I think it'll be sometime in January or February would be a good time to get another program going to determine what benefits or detriments we will have gained as a result of the new administration's program. Okay.
And if I could just touch on one thing, Alexandra, that you mentioned earlier. You asked if we could go back and get this credit retroactively and amend. So it's possible that we're going to see people in 2022, possibly even in 2023, talking to their accountants, talking to their friends, realizing that they're eligible for this credit, filing an amended payroll tax return and getting some monies in that go back to an earlier period. If we're looking at retroactive supports, that would be something that would need to be considered.
Well, let me ask you one other question, Avi. Suppose they file for the retroactive amount. Is that taxable in the year that they receive the refund or in the year that they were supposed to have filed for it in the first place?
Assuming it's on a cash basis, it would be taxable income when actually received. If it's on an accrual basis, it would have to be known to accrue for it at the time.
So obviously, if you didn't know about it in 2021 and you file a request for an amendment in 2022, and you're on an accrual basis, you never have to pay taxes on it?
It would then be known in 2022. So that's when you filed the amended return and when you were made aware of the credits.
Okay. All right, Jack, next slide.
Mm-hmm. Okay, so I'll wait for the slide to be moved. Income available reports. As the slide indicates, is one report sufficient? Well, if the PPP forgiveness occurred in the retroactive period, then you might need two income available or cash flow support calculations. That's because the income in a retroactive period is historical. And if you recall, there was a case called Saprari in front of Judge Uhas downtown. He ruled that a retroactive amount of income available for support was based upon an estimate that was done by a forensic accountant some years back. And that was reversed by the appellate court because the appellate court said, well, if you know what the income was, then you use that income for retroactive support purposes. For example, in Pearlstein, you have a situation, Pearlstein is 137 Calap 4th at 1361. You have a situation where the court was struggling with the issue of capital gains. When should someone recognize capital gains? Well, if you're doing a retroactive income available analysis, you put in the capital gains because they actually occurred. It's no longer a speculative issue. However, if you're doing a prospective analysis, looking at what the most predictable amount of support will be in the future, then you shouldn't include capital gains in most instances because they're too speculative. The market is too volatile. Mutual funds, maybe yes. Capital gains, dividends, things like that, maybe yes, because they're fairly stable. There was a recent case came out in September, a case called Fletcher. I don't have a site for that. I only know
It's 4 Civil G 059134. It's Fletcher with a P.
No, it isn't. It's with an F.
No. You're
Okay.
talking about whether you calculate 1 year's income or more.
Right. No, I was
That's
looking
at Fletcher.
at
It's Fletcher with a P.
All right, whatever.
Trust me.
I'll trust you, Alex. Well, in this Fletcher with a P case, there was a situation in which the court used the last 12 months of this husband's income to determine ongoing support. And it turned out that one of the forensic accountants used it. And the court rightly didn't use it in the Fletcher case because it wasn't a reasonable estimate of prospective income. The husband in this case had a particularly good year last year in the last 12 months, and that was unlikely to recur. So the best option when you have a situation where someone's income is volatile or it has greatly increased for whatever reason in 1 year is to resort to Smith-Ostler and just create a base using maybe a 5-year trend in income. And this way, no one is prejudiced in any way by any increase in income or even a drop in income if the formula could be developed that would take that into consideration as well. So for PPP loans, that works the same way. If the forgiveness was actually in the retroactive period, then you put it in. It doesn't need a Smith-Ostler at all. If, on the other hand, you're looking prospectively at possible forgiveness, then the prospective support should probably include a Smith-Ostler if you follow that one particular judge downtown who I think correctly determined that something that's a contingency should be subject to a Smith-Ostler. Let's.
If I can interrupt for a minute.
Of course, anytime.
Anytime, okay. You're talking about the period that the PPP loan was forgiven.
Yes.
Do you think it would be appropriate to look at the period when the PPP loan was forgiven or the period when the PPP funds were received?
Well, that was the issue in the case I had downtown. And the court resolved that issue in favor of the date forgiven, because when the loan proceeds come in, like any other loan, it would not be subject to income available for support. That's typically the case for loan proceeds. It's not income. The loan proceeds are not considered income for support in a typical case, generally speaking. So that's why he would not. Actually, I was the proponent of saying, well, he received the money and there's no doubt that it's going to be forgiven. So let's put it into the support calculation now, and a wife should get her pro rata share of the PPP loans. And the court didn't buy that argument, even though it came from me. Could you believe it? Anyway,
I was going to say I agree with you. I agree with your argument. It would not be the first time I disagreed with the judge. It would not be the first time that I'm wrong. But
Well, thank you, Avi. At least that makes 1 out of 2.
1 out of 2?
Yes.
Okay.
In any event, I think we can move to the next slide.
Okay, I just want you can move to the next slide, and I want to talk about something because you guys are all talking about Smith-Ostler, and I know it's very easy to just say, well, why don't we just Smith-Ostler it, and then eventually it's going to come back and everybody's going to live happily ever after. What I have noted in the past is people don't pay attention to what Smith-Ostler could come out to be. And that is if you've got hundreds of millions of dollars in forgiveness of PPP loans or any other reason why there is a Smith-Ostler, if it's for spousal support and you did not limit that Smith-Ostler to the marital lifestyle of the parties, which should be defined as to a finite amount, not an infinite amount that the Smith-Ostler would come out to, you're going to be in deep trouble, and you won't be able to go back retroactively. You'll be able to do it prospectively, but not retroactively. Same thing if you have a Smith-Ostler calculation for child support. Now, child support is based on the reasonable needs of the child. So if you have a Smith-Ostler calculation, and I think it turned out that way in Cheriton, you have a Smith-Ostler calculation of a windfall, and these children then would get child support in the millions of dollars. That makes absolutely no sense. So you have to make sure when you ask the judge for a decision or you make an offer for settlement that the Smith-Ostler is limited to what the reasonable needs of the children are, given the lifestyle that each party has, just what the standard language is in terms of the child support for a child or for children who are of parents who are making a lot of money. Okay.
Yes, that's very wise advice. Put a ceiling on the amount so that it doesn't exceed the marital standard or the reasonable needs of the kids.
Right.
So I agree with you totally.
Jack, you also put in here on the phantom income. You put in the Blazer case, and I just want to and you put the citation so everyone has it. What I want to talk about in that particular one is that the court held that when the profits of the business are required for expansion to maintain the viability of the business, then the court is not going to use that money for purposes of spousal support. But I want people to be very careful in reading these cases, because the Blazer case was a spousal support case, and spousal support doesn't have the spousal support statutes don't have a definition of income. So you will have a judge be a lot more generous in child support, where you have a definition that is almost like anything in the cloud is going to be available for child support, but not for spousal support. So they're not as generous with the spouse as they are with the children. So when you read these cases, or when you cite these cases in terms of the Smith-Ostler or PPP loans or ERTC or anything else that comes up that is different or is comes out to be a lot more than what you would expect, take a look at whether you're talking about spousal support or whether you're talking about child support.
So phantom income does impact taxes, as we'll see in a few slides down the road. But the Blazer case is somewhat unusual in the sense that typically the undistributed income from a business, especially if it's 100% owned, personal service business, let's say, is attributable to the business owner. In Blazer, he had been a broker, a berry broker. That's very alliterative. He sold strawberries and bushberries. And the market changed such that the prices were going down because the growers were distributing themselves directly to their customers, supermarkets and whatnot. So he was being kind of forced out of his business. Profits were going down, and he had to vertically integrate. That means become a strawberry and bushberry farmer and wholesaler in order to maintain the viability of his business. So wife came in and said, well, he made $1 million last year. I want my support based upon the $1 million. And he said, no, I made $1 million, but I couldn't take it out of my business because I was putting 600, 700, whatever he did into the vertical integration. Consequently, the court said, yeah, I agree with husband. He doesn't have the ability to pay the support and keep the business. The two are mutually exclusive under those circumstances. So the Blazer case represents an instance where you might be able to argue, if you have similar facts, that the income cannot be completely distributed, and you need to use distributions instead. Oftentimes, distributions are greater than income, so that's not a problem. But phantom income exists when the income is greater than the distributions because you have to show that income on your tax return, but you don't have the money cash in hand to pay that tax on the $1 million as I assumed in my illustration of the Blazer case. And Riddle, which is also on the screen, the husband was a financial advisor, and very often stockbrokers and financial advisors are induced to join different firms by a big amount of money up front in the form of a loan that's non-taxable. But the loan itself is forgiven over the time of the employment. It's kind of like a golden handcuff situation. So in, let's say, in 2019, and someone changes firms, a broker changes firms and gets a $2 million advance in the form of a loan and is committed to work at this brokerage for 7 years. And each one of those 7 years, 1/7 of the loan is being forgiven. Well, in that instance, each period of forgiveness represents taxable income for which no money is paid. All the money came up front. Now, if the community got all of that money, the community, shared it, and the supported spouse doesn't care if the supported spouse, in this case, husband, has to pay tax on these forgiveness that occurs year in and year out. So in that instance, it would be inequitable not to provide for a phantom income analysis on the DissoMaster. And let's go to the next slide.
Before you do that, I just want to make one comment. And that is, and you touched on that in the Riddle case. Suppose that the Riddle case provided for the incentive loan to be forgiven, but it didn't talk about who used that loan. And this is the same analogy to the PPP, because what we're talking about, both you and Avi had said that the PPP loan should be used as income available for support at the time that it is forgiven. However, very often what may have happened is that PPP loan may have been used by the parties and they separated. So now if you're saying, okay, now it's forgiven, let's use that for support, that is inequitable.
Not only that, in that case, to the extent that there's taxes on the forgiveness, if the community got the benefit of the funds, not only would that forgiveness not be considered income, but my belief is that the community would be obligated to pay the taxes because they got the benefit of those funds in an earlier period.
I agree. Okay, now all three of us are judges in this. Okay, next slide. Jack, you're take it away.
I will. Okay, so now we're on how do we deal with this phantom income concept on the DissoMaster? Well, the DissoMaster works on a kind of a two-level basis. You don't see it happening because it's, the computer does it quickly and automatically. But if you were to slow the computer down, you would see that the first thing the computer does is calculate taxes, because it has to have that component in order to come up with the net after-tax income available for support. So when you're dealing with phantom income, you must put the reportable income, whatever it is, whether the person received it or not, into the taxable income line so that the tax is calculated properly. So now the question becomes, if you have a Blazer type case where you're going to be arguing, hey, the husband, let's say in this instance, such as Blazer, needed to maintain the viability of the business, and so couldn't distribute the entire amount and shouldn't be charged with the full amount as income available. How do we treat that on the DissoMaster? Well, there are two ways you can do that. One is, let's say the amount of the income for the year is $1 million and the distributions are $600,000. Easy example. You have $400,000 of phantom income. Where do you put the $400,000? Well, there are two spaces on two line items on the DissoMaster into which you can put that. One is a negative in the other taxable income line. By doing that, you reduce the cash flow that's been calculated based upon the $1 million of income less tax. And
that would be a negative in the other non-taxable income.
Yes, so it would be a negative. You just put a dash in front of the dollar amount.
We can go to page 12 to show that, how you did that.
Yeah, we'll get there.
Okay.
And the other approach is to put it into let me see what DissoMaster, other guideline deductions line on the DissoMaster. But in that case, you don't have to use a negative, because other guideline deductions, when you put a positive number into that input line, it will automatically deduct that from cash flow. So that is mechanically how you would deal with phantom income. And the results can be quite remarkable. Next slide, please. So the assumptions, as Alex was telling you, I'll be getting to this. The example of the phantom income on DissoMaster is the assumptions for the example are shown here. And DissoMaster, one DissoMaster, I assumed that taxable income was 500,000 and distributions of 400,000, and the other assumptions that are shown here. So let's go to the next slide and see what happened. Okay, now unless you have magnifying glass with you handy, I'm going to have to tell you what these numbers are. So under other taxable income, there is a $500,000 amount, and other non-taxable income has a negative 100,000. And if you can't see it, the support is 32,994. Yeah, I don't have a magnifying glass. So anyway, there we go. Thank you so much.
Thanks, Alex.
Definitely $32,994 for Zoom.
You're muted. Wait a minute. Wait a minute. Now we're muted. Jack?
I'm muted?
You're muted.
I can hear you, but not Jack.
Okay. So if I'm not muted, I'll keep on talking.
Now we can hear you.
All right, and the spousal support, as shown, is $69,282 for a total of $102,276. Next slide, please. Okay, and great. Now, just to show you what that type of treatment, how that type of treatment can benefit your client, if the client is the payor. You saw the amount of spousal and child support on the previous slide. Now compare the situation where the 400,000 negative, the 100,000 negative is not shown on the other non-taxable income or under the other guideline deductions. Yeah. The numbers are quite different. The results in that case are annual child support of $44,567. That's a $12,000 difference. And spousal support of $107,000. Right. The combined change is $49,368. So if you weren't aware of that situation, that could be a huge error for a particular client. So that's why it's important to know how to deal with this phantom income issue when it comes to the DissoMaster. Next slide, please. Okay, what about business losses? Typically, I include certain business losses when they're part of the marital standard. They're part of the history of the marriage. An example is a rental property. The parties may have had that rental property for years, and oftentimes they couldn't, the principal and interest on the mortgage and taxes were greater than rents, and with vacancies and commissions to real estate brokers for the renters. So what do you do with that? Well, I put them into the income available report as a deduction from income available. If it's one party separate property, obviously that party benefits from the loss. If it's a community property and it's temporary support, then it really doesn't matter. Both parties equally share the loss, and there may be a slight variation in the numbers, but it's not material. However, there are certain cases where people are taking losses that the courts find inequitable. A case like that was Sorge. Now, Mr. Sorge was investing in a lot of new projects and was losing money because most projects have startup costs, and the startup costs were causing the large losses to be incurred. And he took those losses on for purposes of calculating income available for support. And the court knocked him down on that and said, well, wait a second, Mr. Sorge, aren't you worth $63 million? And Mr. Sorge says, yes, I do have $63 million. So you're saying that these losses will impair your ability to pay spousal and child support? And Mrs. Sorge said yes, but the court said no. The bottom line is where the amount of the loss that the person is claiming it does not impair the ability to pay support, then that loss should be ignored.
I also would say, Jack, is these are very fact-intensive cases.
Oh,
doesn't
sure.
necessarily involve only the forensic accountants. The forensic accountants can use various analysis and analogies and so on and so forth. But in the Sorge case, for example, the guy had a company that was a Strategy and Holding Corporation, and he sold the company. He was making $800,000 a year. He sold the company for $100 million. And then he started investing in startups and says, I can't pay so much in child support because I'm doing all these losses. And maybe by the time the kids are about 37, I'll recoup my investments. And the judge said, as you indicated, no, that's not the way it's going to work, and forget about it. So you have to take a look at the fact specific of what it is. And if I were the attorney for the wife, I would have made the same argument. Look, the guy is still riding around in his airplanes and his whatever it is he's doing, and he's not even reducing his assets altogether. So keep that in mind.
And Berger is pretty much the same kind of case. He was a CPA and was making a nice salary. He quit, decided to do investments, and he gave himself a lower salary. And but he had, he was a fairly wealthy guy, and the court found that he more or less was manipulating his income so that he would have to pay less support through paying a lower salary from his investments. So there are losses that are manipulative or that don't impair the ability to earn. Would be a difficult job to get a court, given these two precedents, to find that the losses are permissible. There was an older case, Marriage of Dick, if you recall that case, with the fellow who had a mansion on the Isle of Wight, I believe it was. And he said, I have no income. And the court said, sure, you have no income, but we're still going to charge you with child and spousal support.
We'll impute it.
Exactly. So, okay, Avi, we're going to turn it over to you because I've been talking too long.
Thank you, Jack. Next slide, please. Okay, so I'm going to talk a little bit about other tax changes. We talked about PPP and ERTC, but there are a number of other changes that came about starting from the CARES Act, the Consolidated Appropriations Act, and the ARPA. One of those being unemployment benefits. Many people have asked, with the proposals being talked about in the Biden administration, can they change the tax law retroactively? What happened with unemployment is an example of a tax law change that can be affected retroactively. This one was taxpayer friendly. That for 2020, the first $10,200 of unemployment are tax-free. That came about in March of 2021. So any tax returns that were filed before that date would have picked up the full unemployment as taxable on the federal level. And your clients would be surprised with a refund above and beyond what was stated on his or her tax return. For DissoMaster purposes, since this benefit is non-taxable, the first $10,200 of it in the DissoMaster input, like Jack so eloquently explained, if you put the DissoMaster inputs incorrectly for purposes of taxes, your result will be equally incorrect. This portion of unemployment should be treated as non-taxable income. However, this is a 2020 issue only. It does not apply to 2021, at least as of today.
I wanted to point out that I was looking at my watch, my cell phone actually. It's 6:53 and this program probably will end in 7 minutes. And we have something very important to tell the participants. Avi, would you mind telling them about AB 150 and the workaround?
I'm gonna skip ahead to slide 19 if I can. Okay, so I apologize about the size of it. Thank you. So one of the most significant changes that were implemented during the Trump administration is the salt limitation. Salt is not a spice or a condiment that you put on your food as it relates to income taxes. SALT stands for state and local taxes. Until 2017, taxpayers were allowed to take a deduction for all state and local taxes paid. That includes income taxes and that includes real estate taxes. not as much of an issue for people living in states like Florida or Nevada, where there is no state income tax and where real estate taxes are not as high as in states such as California. But in California, this was a big deal for a lot of taxpayers, where they were no longer able to deduct their state and local taxes paid above and beyond a cap of $10,000. Many legislators didn't like that, and they tried to come up with various workarounds. And based on some IRS guidance, there was a newly sanctioned IRS workaround, which essentially what it allows is for business owners to have taxes paid at the entity level and then provide a credit that's passed through to the business owner. So you're not, quote, directly deducting the state taxes on the individual return, but the effect is the same. So let me give an example and put some numbers in there. Let's say you've got a business, you have an S corporation, you own the S corporation, and the corporation made $1 million. You're allowed to elect for the business to pay the taxes, even though the business doesn't pay any federal taxes. The taxes are passed through to the individual, but you can elect for the business to pay the tax at a rate of 9.3%. And you would then get a credit on your state tax return. So again, if the business made $1 million, the business would pay $93,000 of taxes. And instead of passing through $1 million of taxable income, the business would then pass through $970,000 of, no, sorry, 9.3%, $907,000 of taxable income. So essentially, even though the individual is not deducting the $93,000, the individual is paying taxes on $93,000 less, which essentially has the same impact and is then getting a state tax credit of $93,000. This applies to business owners only. It does not apply to individuals. It applies to a pass-through entity, including an S corporation, LLC, LLP, or limited partnership. It does not include publicly traded entities. And the owners can only be fiduciaries, estates, or trusts. So if you have a partnership where a partner or an LLC is the partner in the partnership, that would essentially disqualify that partner from electing this AB 150 treatment.
So it doesn't apply to proprietorships.
It does not apply to sole proprietorships as well. That's correct.
But the in 2021, let's say you've paid your first two estimates for June and for April and June. You made your estimated tax payments, and in your example, let's say your tax is $93,000 or so. You've already paid $60,000, so let's say your third estimate was going to be $30,000. What you can do, if I understand this AB 150 workaround, is to, instead of paying, making out a check from your personal bank account for $30,000, you go to, if you're in a partnership, you go to the controller and you say, please send a check from White Zuckerman to the Franchise Tax Board for $30,000 for my estimate. The controller,
so it would not be $30,000. It would be at the 9.3% tax rates. So for 2021, you would end up essentially giving an interest-free loan to the Franchise Tax Board, but you would get this $93,000 deduction that otherwise you would not be entitled to.
So if I've already paid my estimates personally the first two times, and I only have one more estimate to go for 2021, isn't the most I can get my controller to pay for me without having to have a big refund that I can't get it back in cash, but have to roll over $30,000?
So it's a flat 9.3%. Either you elect in and you get the deduction, and in this example, you would be overpaid, or you don't elect and you don't end up getting the deduction, but you're not overpaid at the state level.
So let's go back into my example, which is very dear to my heart. If I said to my controller, pay my state income tax, and he says, okay, I'm going to cut a check from the firm for $93,000, reduce your federal taxable income by $93,000. He cannot do anything less than $93,000.
I believe that's correct, assuming the income is $1 million.
Right. And that means that I've overpaid, because I've had previous estimates, I've overpaid by $60,000, let's say, if my tax is really at 9.3%. What happens with the refund? I understand that it is not refundable, that the only way you can use it is to move it into the following year's tax liability. Is that correct?
So the credit, you have this $93,000 credit. Is it a refundable credit? Not sure.
Okay, well, to be continued.
Now, all of this may become a moot point, because if Congress passes a bill that reinstates the SALT deduction, AB 150 goes by the wayside.
But at least for this year, I think they're not going to go back retroactive. So you might pick up a few dollars, as I intend to do.
Now, in California, you have until you don't make the election. On a go-forward basis, the election has to be made by June 15th. But since this didn't come out until after June 15th, I forget the exact date, but there's a date in 2022. I believe it's the date that the return is due, which would be March 15th for a partnership LLC or S corporation to make the election. That's California. I know, for example, New York has a similar workaround that the date to make the election is October 15th. So many states are coming up with their own workarounds. My personal belief is that it's quite likely that because of this, Congress will reinstate the SALT deduction, but I don't have a crystal ball. Jack, I'd be willing to bet you lunch on it, but probably not much more than that.
Oh,
all right.
So
well, I'm not a betting man, especially with
with
Joe Manchin and Kristen Sinema in Congress. In any event, it's past 7 o'clock. I don't know what.
We have a couple of more minutes, I think. Avi, were there other changes? The child tax credit, a lot of people don't understand it. And would you just talk about that for a couple of minutes? And then I think the rest of it is on the handouts.
So if we can just go back to slide 17. Thank you. So the child tax credit for 2021 only. Again, there's talk about this being extended, but as of right now, it is 2021 only. It's increased from $2,000 to $3,600 for children under the age of 6, and to $3,000 for children between the ages 6 through 17. For reasons unbeknownst to me, this used to end at age 16. Now we're going through age 17. And again, the changes are for 2021 only. Now, many of our clients have already started seeing the benefit of this tax credit, because unlike other tax credits that you only get when you file your tax return, for the additional child tax credit, payments began in July of 2021. Now, the credits are going to go to whoever claimed the child in 2020 on his or her tax return. So if you have a situation where divorced spouses are alternating the exemption or the child tax credit each year, the recommendation would be to stop the automatic deposits. You can go to the IRS website to do that, so that only the spouse that's entitled to it for 2021 is getting the credit, as opposed to the spouse that claimed the dependent in 2020. The phase outs for this credit are a little bit lower. In 2020, the phase out was $400,000 for married filing jointly for the additional portion only. So again, the additional $1,600 for those under the age of 6, and the additional $1,000 for those between the age 6 through 17. The phase out begins at $150,000.
Thank you. I just want to thank both of you, Jack and Avi. You were so wonderful when I wrote Heard on You, and we had, I don't know how, we must have had at least 7 or 8 meetings. And Jack was redoing the PowerPoints, and I would send him, no, you do this here, do this there. You guys are really, really terrific. And thank you.
Always a pleasure to work with you, Alex. No,
I will work
pleasure
with you.
Pleasure to work with both of you.
Thank you.